Okay.
Okay, so good afternoon all. My name is Arturo Pereira and I'm the General Manager Director of BiG Spain. It's a pleasure to have you on this event in collaboration with our strategic partners, Saxo Bank. We hope you enjoy very much these two great speakers. Before leaving the floor to my colleagues, let me remind you all that during the presentation, the website channel will be open for any questions that might arise. As I do not want to talk the spotlight away from those who are really important today, it's a pleasure to introduce you Steen Jacobsen, Chief Economist and CEO of Saxo Bank, and my colleague Joalan Pereira, Chief Investment Strategy of BiG. Thanks again for your attention. I'm leaving the floor to you now, Steen. King regards.
Obrigada. Thank you, everybody. A great pleasure to join our friends at BiG for this event. And I think, as you all may know, what has transpired today is a great day to meet up and talk about these two, the subject of interest rate and inflation. So if I may just have my first slide. What I think I need you to take away, whoever you are today, is that, you know, maybe the way to do it is to think about your children and the next 50 years of investments. The ability of your children to take away return from the markets is very limited. And why is it limited relatively to the last 50 years? Because the last 50 years we have seen a continuous process of lower interest rate and lower inflation feeding each other into a monetary policy which is entirely and has entirely been driven by the financial conditions, as we economists and trader will call it. The financial conditions is the way that we have dealt with every single crisis that's been in history. So from a return profile, it's very difficult to make money when you have the most expensive equity, the most expensive housing market, you have the single biggest wage cost push that we've seen since the 1970s. And on top of that, we have a change of monetary regime. So we just go to the first slide again with the Mr. Carter and Mr. Biden. So the fact that I think very few people in the market seems to have realized, and the magnitude of that thing is the following. In all of the history of Federal Reserve, which is more than 100 years, we've only ever had two American presidents asking the Federal Reserve to hike interest rates. The first one was Jimmy Carter in the 1970s, but Jimmy Carter, in a political perspective, was late to the party in the sense that he realized inflation was an issue. He then, of course, appointed Mr. Volcker on the right in the picture to fight the inflation. And Volcker, of course, became this well-known figure in the world of creating what we today operate under, a maximum inflation range. However, what we also seen is that Biden has now totally taken control of the Federal Reserve. So this concept of the Fed being independent is out through the window. The reason we know that is pretty clear, because when Powell and Ms. Brainard was going to be appointed vice chair, they both went to the White House. And at the press conference that followed that meeting at the White House, both of them had pivoted 180 degrees from the basic point of view they've had on inflation being transitory to being what they now call fighting the regressive tax of inflation. Every single meeting, but in particular the FOMC meeting last week, confirmed this stance. As you know, a lot of people came out of the FOMC meeting last week saying there was a hawkish tilt, Fed may have to deliver. Today, as we talk, there is a Senate confirmation hearing on three additional governors for the Federal Reserve Board being appointed. All three of them are super doves. All three of them in pre-release text to the Senate all of a sudden thinks that fighting the regressive tax of inflation is the single most important point. So what I'm trying to combine with your story of the next 50 years for your children and what has been going on since 1998, when we had the bailout of the FOMC and the introduction of the Fed put, is that we are no longer in the same financial environment. 2019, 2020, 2021 was still, if we go to the next slide, was still under the concept of seeing lower financial conditions. So this is the financial condition, which is, as most of you will know, a combination of factors, but mainly the stock market, the credit spreads, the 10-year interest rates on a relative basis. What the Federal Reserve believe and what academia believe fights inflation is a tightening of the financial conditions. The financial condition up until this reversal from the Federal Reserve, from Powell and Ms. Brainerd in November, was driven entirely on the concept 10% out of the money, there is a Fed put. And if the Fed put doesn't work, there is an easier incoming monetary financial conditions. The problem they have on the other side now is that now they have been asked to fight inflation. And as they fight inflation, they are totally out of context of timing what goes on. So what we have done with the Federal Reserve and what they have done to themselves is that today they are chasing inflation. They have excluded their ability to be preemptive, a word they have used very, very, very dominantly in their communications. They don't have a forward-looking plan, but instead, whatever the market think is consensus is going to be the point to which interest rates are going to be driven, simply because the Federal Reserve lost control of the process. On top of that, they are, again, as I try to frame to you, under the only for the second time in history, the rule that the Federal Reserve will dictate what goes on. So when we move at interest rates, and please take the next chart, that's fine. When we look at, so when does interest rates start to matter? Well, today in Europe, the interest rate move matters. Why does it matter? Because the significance of the move is what we will normally define as a 2 standard deviation move. So it's something that happens very, very rarely. As you can see in the middle part of this chart, every time we have a peak in terms of the standard deviation, in terms of the move, you on the lower line can see the return, the rate of change of the market, and the magnitude, the scale of this is a little bit difficult because it goes from minus 30% to plus 30. But basically, every time we have a 2 standard deviation move up in interest rate, we have a significant downdraft of the stock market in the following period. So monetary condition is the vehicle by which the monetary authorities feel that they can actually tighten the condition. They can make sure that you contain inflation. If we now fast forward to what I believe to be the consensus of the market, that it is fine that the Federal Reserve wants to talk about being hawkish, and they should be talking hawkish because of the absolute level of inflation. But their ability to actually deliver the amount of hikes, 3 to 5, essentially 5 right now, is going to be very difficult, because as they do that, they will, of course, slow down the economy is the concept, and they will make sure that they sort of leave some room for a put on the equity market. The problem with that argument is that it's to a large extent is circular. So let's assume the consensus is right. The Federal Reserve moves in March and maybe in June, and then they stop after only 2 hikes. But if they stop hiking interest rate in June, the monetary conditions, as we look at before, will still be extremely loose, which means that the forward-looking inflation expectation will have to go up. So basically, you will see the reverse of what we're seeing right now, which is a flattening of the yield curve. You see a massive steepening, because basically the Federal Reserve is putting the majority of their focus on the liquidity in the short end and the ability of the market to trade. So right now, I will argue there is only 2 things that can get the direction of the market to change. The most natural one is a pivot by the Federal Reserve. But I think the hurdle rate for the Federal Reserve to change and pivot to a more neutral or even more bearish point of view is extremely difficult, exactly because it's counterintuitive to the mandate given by the White House, counterintuitive to how academia and the Federal Reserve themselves sees the transmission from monetary policy to the real economy. Then we add to the top of this, of course, the supply side issues that continues to extend in time and continues to be more and more complicated. I don't think a lot of people who are not in actual business understand the complexity of a logistic system. I think for most of us, we sort of look at our wives and our daughters, going down to a place, leaving a parcel, a package to go somewhere, and then it's done. But when you look at the global infrastructure, it is extremely difficult to run, and it is deficient in many places due to not enough labor force, because of ships not being available, because ships are in the wrong place, or simply because we have port congestions in different places. What I argue, my number one thing is that do understand this is once in 100-year event that they have changed the monetary stance. The second part is that inflation is structural, it's no longer cyclical. And the reason it's structural is that if we take something like ESG and the green transformation, which I think a lot of you personally are involved in and believe in, but what we do when we execute on a green transformation, the green taxonomy that the EU now is proclaiming to be the overriding sort of framework by which we have to do things, then what we do is that we reduce the amount of capital available to deal with the supply constraints that we have. So if you don't want to do fossil energy, if you don't want to do mining, if you don't want to do a number of investments that creates an increased use of non-ESG commodities, then of course you are in itself increasing the price of what goes on. So the more successful we are in moving customers and assets to ESG, the lesser capital will be available to deal with what is the real concern for the economies. And that is, having a baseload of electricity going into the grid network. And right now the politician tells you, well, it all needs to be solar, it all needs to be wind. The problem with that is that is part of the solution, but it is not the solution. We need, and is what is going on this year is, of course, that we probably will have a reclassification of nuclear and a reclassification of natural gas under the auspicity of these things that we're trying to do. But the problem is that this shows you why things are structural. You can do whatever you want. Electricity prices is going to be exactly this high next year as well, independent of the weather. Why? Because the capacity and the ability to actually develop a better grid network or more baseload electricity down the line is not going to improve. It's going to get worse into the future. Right now, it's so bad that the yield carry that you have in commodities for a Bloomberg commodity index is plus 5%. The biggest single carry you have in the world right now is in commodity relative to the risk, because every single commodity we look at in our research have an increased deficit between the supply and the demand. In other words, if you think inflation right now is high, then 3 years down the line with increase in ESG, the structural issue not being replaced by better things, we will end up in a situation that is higher. And this is what I'm showing with what the normal regime chart is. So the market, if you look at the swaps, if you look at the 1 year, 2 year, the 2 year, 3 year, it's basically saying that the terminal rate in US term is 200 basis points, and then you need an additional inflation hedge on that. So the corridor that everybody expects us to return to, including the ECB today, is somewhere north of 2 and south of 3%. I'm arguing because it's structural, because the Federal Reserve is late to the party, there will be a cyclical aspect into the structural aspect that keeps inflation higher for longer, but also moves the corridor from the expected range of 200 to 300 basis points and to 300 to 400 basis points at the ultimate outcome. So when you look at your portfolio going forward, you have a higher volatility and you have a higher convexity in those portfolio. And the single biggest risk you have is Fed being late to the party. Next slide, please. So how do we come to this place? And this is, you should always be careful of putting more than one line in a chart. I know this, but if I tell you that the top part is the total amount of stimulus, the second chart is the underemployment, the third one is the inflation right now, and the bottom part is where Federal Reserve is. We are looking at the highest fiscal impulse ever in history in the US. We are looking at the single biggest underemployment ever in the history of the US. We already have inflation, and Federal Reserve is still doing QE while we talk tonight. This is the biggest mismatch ever in history. But let's focus on the second from the top chart, which is the minus part. So right now in the US, there are 10 million jobs available, actually 11 million jobs, and 4 million people who are unemployed. So when the base effect of inflation starts to come down, what will kick in instead is the structural issue in the metal and fossil energy space is still the same, but wage cost is going to explode if we take the next chart. So if you look at the actual underlying wage inflation, already now, before we get to this point, is that we're seeing a 5% to 6% inflation rate. And most of you know from an economics perspective, this is what we call the second round effect. And second round effects is sticky because how often, well, it happens to my salary, but not to a lot of salaries that they go down in actually what people earn. There's very few people who are seeing pay cuts. So what you have when you have inflation in wages is that you have something which is sticky, which to a large extent is negotiated by unions and then enforced into contract. So what we perceive to be the bigger risk this year is that, yes, we agree that there are base effects coming off inflation, but that will be 2 months from now because the first quarter of 2020 was still low inflation. It really kicked off as we got into the Q2 of that discussion. Next chart, please. And as you probably saw today, the consumer is now being hit by what goes on in this non-working and non-performing energy sector. So the Ofgem, which is the regulator in the UK today, increased from April 1st the price of electricity by 55%. I repeat, 55%. So the cost of the system that is inefficient in supply and demand, because of the way that you construct consumer contracts on energy, has a delayed effect that is now kicking in. So much so that the British government today is going to give every single household under a certain income £250 to pay for those £550 that the price got up. And think about it, £550 for an average family in the UK is a lot of money. And this is only the beginning because actually the prices are trading north of that. Next slide, please. So what I'm saying to round it up pretty quickly is that, one, historically, we are for the second time only since the 1970s in an environment where the Federal Reserve is dictated by the federal government and the White House and the economic situation to fight. They now will proclaim that they have reached the full employment and that the inflation is now exceeding, but they are late to the party. So understand that the Fed, the ECB and Bank of England are all chasing inflation. They are not ahead of inflation. So this concept that because we have 5 hikes priced in, we have a market which is already saying Fed is going to deal with. No, that is not the case. Federal Reserve will continue to be pushed on a string because basically they have underdelivered on the promise to keep inflation stable. In other words, they have really said to the American population that we will focus on the 4 million people being unemployed instead of the 200 million being in employment. The 200 million people in employment are seeing a massive deterioration of their wage pay slip. And that's why, of course, the government, in this case, the White House, steps in and say, we got a midterm election. We are 2 years from the next election. We need you to focus on the 200 million, not the 4 to 6 million people who are unemployed. On top of that, because of the fiscal drag, because of the slowing down of the QE program, we are operating with a global liquidity picture, which is already negative. So everything being equal, if we have to have the equity market to do well or risky assets do well, we have to have a higher earnings relatively to what we see right now. To a large extent, we are right now, as we talk again, we are back for green transformation stocks, for stocks with bad balance sheets, for stocks with no earnings. We are exactly back to the level we were in 2020 when we started the COVID-19 crisis. So we have been a full cycle of waste of time, waste of resources into a process where basically today we are back to that fundamentally value stocks is outperforming massively, and they are outperforming massively because their ability to withstand the incoming interest rate hikes is much better than stocks that had a high convexity, or in layman's term, stocks that are exposed to small changes to the interest rate environment. So for me, the concept of the setup for 22 is not necessarily that it's super negative and we can navigate this, because I think we can navigate this, but the concept that we live in a world where the Federal Reserve will come to your rescue, you need to take that off the table. There is a Federal Reserve put, but it's not 10% out of money. It's probably 20 to 25% out of the market. And it will almost entirely be based on illiquidity. So when the credit market freezes up or the repo market freezes up, that's when you will see the Federal Reserve act. They will not react to slowdown in equity returns. And that's is the misconception that a lot of people have. The Fed cares about the stock market. No, but they care about the liquidity and the financial conditions. But for the first time since the 1970s, financial conditions for inflation reason, for political reason, needs to be tightened irrespective of where the stock market is. And that is the big challenge we have as an allocator. That's the big challenge we have as investors. Pretty much anyone who will be playing by the same rules that we played with since 1998, in my opinion, is doomed to fail, exactly because your ability to see lower interest rate is there, but it's limited. The ability to see lower inflation is, in my opinion, relatively to where we've been, very, very, very almost close to zero as well. So we have two major dynamic changes to the structure. Inflation is structural. We have a political will to actually, both from the White House, but also from the Federal Reserve, to fight inflation that we have not seen similar commitment to since the 1970s. So in other words, I think we are going back to price discovery. We are in a market where macro and the lack of hair, which I have, is going to be a good thing. And people who wants to model things is going to have a difficulty, because if you model anything, you are modeling backwards into a situation where the response function has always been to loosen monetary conditions. This time we will have a tightening monetary condition because we are late to the party. That is the price of creating too much debt. That is the price of being late in the decision making, of taking away the alcohol from the party. Thank you.
Thank you so much, Steen. I'll address quickly my presentation. Great presentation. We agree in many points. Some others it will be interesting to address in the Q&A. I'll be very brief because I have a three-theme approach on the next 15 to 20 slides. A very quick macro snapshot in the next couple of minutes. Of course, we project 2022 in a year where world growth will remain above pre-COVID trend. And will be, of course, we will see some recovery faster in Europe and in emerging markets relative to the US. That is mostly based because of this massive fiscal transfer and monetary conditions that was created in the US, which is unparalleled to what happened in Europe. So the US economy dropped much less in 2020 and recovered much faster in 2021. And so there is an effect of a catch-up effect of the Eurozone to the US on the medium to long term. And it is interesting that Tina has already explained that employment was much better defended in Europe relative to the US. But sorry, my slides fell through. Sometimes this happens. Next slide, okay. So as Tina was saying, so we have had still 4 million people that haven't recovered employed in the US, but still the slack in Europe is much larger than in the US. So it's quite different between this trajectory of the employment that Tina has already mentioned, the stark contrast of it. We're seeing the aggregates of GDP dropping sharply in terms of growth. Of course, we've had excess savings in the US quite tremendously. So we don't really know how this burden of regressive tax of inflation will play out, because we have this cushion of extra savings in the US that, of course, we don't have in Europe. So the key thing of supply and demand issues is very different between Europe and the US. So real wage growth is negative for the last 8 months in the US, and so this will hit consumers and housing expenditure going forward. Well, of course, it's 70% of the US economy. So we have had a supercharged recovery, asymmetric from goods and lagging in terms of services, much more noticeable in US relative to Europe. Of course, when the last Omicron wave hit in the final quarter of last year, we've had a couple of receding or worsening economic data and high frequency indicators. So we take a look at Omicron as we did before with Delta, Alpha in the first wave. So each wave that has gone through, the economic effect has been marginally lower, and this one is no longer different. Still, there are some risks. But there are some risks from Omicron to the supply chains. Of course, that's the thing I was saying. We have a very different, and even Lagarde on the press conference today is saying that the sticky inflation in Europe currently is pretty much related to the supply side of the economy. But as we know, In the US, it's both supply and very pretty much demand. Either way, we have a pretty different contrast between inflation across all regions, and we've had preemptive tightening in the emerging market world. But still, this Omicron variant hasn't, receded the supply constraints that we were hoping to see in the last quarter of last year. So this receding costs have, in terms of container shipping, has actually stalled, and it depends very much on how China will lead. Will deal with the COVID-free, from COVID-free to dynamic suppression, especially after the Olympic Games. So on top of this, the aggregate demand is obviously having a negative effect. So China is actually desynchronized global play on this, because of course they are playing this reflation policy in terms of fiscal and monetary, which is quite interesting. And as we know, China underperformed massively across the board last year, also because to the regulatory crackdown. But on top of this, we have the aggregate demand pulling or going downwards through fiscal policy weighing down on growth in the US already, and of course the tightening, which will be pretty aggressively in the US going forward, and also in Europe. So in terms of real disposable income growth, as I've said before, we've had 8 months of real negative wage growth. So all these indicators have fallen sharply, and this should, translate moderately to a bit more decelerating increase of aggregate demand, because of course the inflation is of course a dynamic concept, a growth concept. So what we had last year in terms of increase of aggregate demand, increase of monetary base, and the base effect from price distortions will no longer prevail, but still the excess savings and the tight labor market in the US, they will weigh up, so probably will prevent inflation to come down as quicker as many policymakers expected. And still, the key risk, I think, is that, as Tine was mentioning, the market is very comfortable with inflation expectations going forward. So if we take a look at 5-year inflation swaps, they are pretty much in line with the 10-year average. And still, we take a look at the break-even curve in the US, and it's also pretty inverted. So this is a key risk going forward. Of course, we don't see the Fed over tightening policy to bring down inflation, because they've been late to the game and little signs of reversing. But still, there's a clear sign that the growth can actually fall and inflation becomes more entrenched despite all tightening efforts from the Fed. And so this could actually create some tailwinds for stagflation scenario, right? And so we see this GDP growth to recover slightly more in Europe, as I've told you, and the emerging markets against the US, but this is mostly to cyclical catch-up. We see a downward shift to inflationary pressures, but they will still persist. Of course, more elevated than we'd hope by the end of last year. And of course, the ECB will lag the Fed always. Of course, in the last cycle, they weren't able to pull rates up, and emerging market is clearly on a different path of its own. And what does this mean to the financial assets on bonds? Of course, nominal yields, and this graph was shown also by Steen. Nominal yields are bound to rise, essentially driven by the increase of real yields, and that is actually what has happened already in January, and it's pretty much similar to what we saw in the last tapering event in 2013, 2014, where actually real yields went through the roof to 200 basis points, and nominal yields went 150 basis points, because break-evens actually receded around 50 basis points. And we are seeing break-evens receding in the last couple of weeks. So essentially due to of course the interest rate market being quite aggressively pricing in 5 hikes already. So what does it say to the curve? Interestingly, usually in the beginning of a tightening cycle, the growth prospect, the tightening cycle occurs because the growth prospects are quite good, but this time is pretty much different, because we haven't had inflation at these levels over the last 30 years. So the economy is booming quite so much, And so the market is pricing in a different set, because usually you have a steepening yield curve when usually the tightening cycle begins, and we've had the polar opposite of this. So a pretty flat yield curve currently, especially around the 5-year which we think is the sweet spot of the yield curve in the US, both on carry and on roll down. And so this is quite interesting, because the Fed is trying to engineer a soft landing, but it will probably fail to do so. And policy mistake can go either way, but it's most likely will be that it will be very difficult for them to actually pull out at least 5 hikes this year, and does not lead to a weakening growth prospects. And so there is this prospect of the curve to actually steepen a little bit with this. And if you take a look at the last exercise of the balance sheet runoff between 2017 and 2018, where do we see the 10-year nominal yields by 22 year end? We can see that around 2018 we saw an increase around between 60 to 100 basis points from minimum to maximum increase on the spike yield on the US 10-year. And so we've seen currently the 10-year are around 185, so we've seen like 35 basis points increase since the beginning of the year. So if we take a look on the low base, we could see at least some 30 more basis points up, or some 60 basis points up. So we see the 10-year probably around the 220, 230 by the end of the year. And this is already pricing in some sort of quantitative tightening around a balance sheet runoff between 1 to 1.5 trillion to be accomplished of long duration assets in the next probably 18 months or so. But these financial conditions are still very accommodative, so very loose. Of course, the credit spreads usually on the beginning of a tightening cycle they do quite fairly well. If you take a look at the average and on the historical average, the same way as the curve usually steepens a little bit when the Fed actually starts to do this tightening cycle. So the credit spreads will have just started to widen, and will probably do a bit more. This is the investment grades. In terms of European debt, the peripherals, of course, ECB we had today, of course, important meeting. Of course, still we have the PEPP being phased out to the APP, and we'll have around 20 billion of purchases available on the third quarter of this year. The market's already pricing in a possibility of a rate hike. Actually today moved up a little bit from 25 basis points to 40 basis points rate hike eventually by the end of the year, something that of course Lagarde is actually trying to distance itself, but still of course, we saw a big impact today on bonds. There is some negative net supply still on most of the issuers, because most of the supply is coming through the EU Commission. As you know, we are going out of COVID, and the fiscal policy is just coming into European economy. It's a polar opposite of what happened in the US, of course. In this sense, it also this makes a stark difference between the fiscal multiplier of what is the fiscal policy in the US and what is the fiscal policy in Europe. But we've seen a quite sharp rise in yields across the board. So of course today we're seeing the bonds already at between 10 to 15 basis points, and we saw finally for the first time a move a bit steeper on the spreads on the peripheral. Of course, because until now, the spreads have been pretty much contained, and I would say to remain a part of the mandate to keep price stability. It's not only inflation; it's also a question of the stability of the peripheral spreads. Regarding to emerging market debt, we see some less vulnerability to Fed tightening relative to past experience, especially because of much better underlying fundamentals, especially on surpluses of the current account, and of course of the preemptive fiscal on the preemptive tightening monetary policy that we've seen recently. More recently, we saw Brazil the other day. So much more advanced tightening cycle in the emerging markets, the stronger recovery dynamics, of course, also supercharged with the price recovery we're seeing on the commodity side. And of course, we are positive on on the reflation story regarding China, which will also be, of course, positive to emerging market debts and emerging market equities. And to cap it off on the equity market, of course, I mean, we've had a kind of a sell-off since January. Actually, on the tech, the sell-off has been led, of course, by the technology side, and the technology sell-off has been already led in December, has started in December. So this is kind of, the equities are mirroring exactly the valuations, the pricing and valuations of equities are mirroring what real yields trajectory are doing. So, so we don't have any reasons to believe that this thing will change. And of course, sectors that, of course, are bound to benefit from increasing interest rates on real basis, of course, will tend to benefit, like the financials, as you see on the right-hand side below, as the polar opposites to the technology sector. So this will provide this technology, which is a long duration asset, and as of course, being a secular stagnation again, it has been a great beneficiary on the last 10 years, secular stagnation from 2010 to 2020. And if we count with the 2 years of the pandemic, the technology sector, of course, has ballooned. It already ballooned before, and it has doubled ballooned in the last 2 years. So in a 12-year outperformance, and this, of course, we have many reasons to believe for this course to finally reverse. So we're calling this already for 18 months. It's finally played out as we expected in the last 6 weeks or so. So the valuations are, of course, a concern. So the Fed is tightening on the equities, and of course are expensive on a fundamental basis, but so quite different from what we saw in the 2013 example. But still, we can find some comfort. We are not, acknowledging we're not on the ledge, acknowledging a sharp correction, because equity risk premiums, they still remain quite distant to past equity market bubbles. If you think about .com bubble in 2000 or the 29 crash, if you adjust to real yields investment. So this, of course, this is a concern. This is a trade-off, and we will probably not have the buy the dip mantra we had in the last 18 months or so, more like buy the dive or something like this. But we'll have sort of many catch up and dispersion plays to do. Of course, as Tim acknowledged about how the Fed will try to cope down with inflation, and of course, it's pretty interesting that the market is pricing, the interest rate market is pricing the Fed quite aggressive on the front end, already 5 hikes this year. But the terminal rates hasn't barely changed, so it's around 1.75 to 2%. And Sina already mentioned a low corridor that will be additional between 200 to 300 basis points. So we're talking about, it is quite interesting that more hiking from the Fed now equals less later. So this doesn't make much sense. So the pricing on the interest rate market was quite aggressive on the front end, but not so much on the long end. And so I think the equity market will probably still find some pressure when finally the pressure comes, if the long end or the terminal rate of the Fed will naturally be higher than what the market is currently pricing. But if you think about previous tightening cycles, actually the S&P 500 has done fairly well. If you think about 2004, 2006, the S&P increased around 16%, and of course in 2015 to 2017, around close to 40%. But as we both said, this is a very different cycle. The economy is on a very different trajectory, and especially the inflation. And so we're going to expect the Fed to doing much more. Of course, this is especially a concern for interest rate sensitive sectors as it is the tech sector. And this is a big thing, especially in the US, where the concentration risk is of a key concern. But if you think about strictly fundamentals, they don't seem to be on an imminent ledge. I mean, we've seen big moves. We've seen today Meta, big sharp correction. I mean, 200 billion drop on market value. It accounts almost around 450 market value companies of the S&P 500. But what we're seeing, it's a real dispersion within the technology sector. Of course, the low quality and the highly speculative names, as Tim said, they have all reverted last year, and of course they are keep declining this year, but we're still finding some stability within the main themes. But the big tech as a whole, we don't consider, if you take a look at valuations, .com, and even in the Nifty 50 period in the 70s, the big tech, they don't seem to be ultra expensive, especially regarding to the fundamentals. But of course, this graph on the left was when the S&P was reaching all-time highs around the 4,800. And this was already, we're seeing already the technology sector already drawing down a little bit more. And if you exclude the market cap weighing, the S&P would be around 30% lower than the 4,800. So this is a concern, and this is fundamentally an issue why we believe U.S. equities will finally be underperforming world equities along 2022. So if it is quite interesting that in the December last year, we saw the S&P growing to those 4,800 points record, and the NISFANG already dropping. So there was this market breadth improving, and this will probably align with our favorite equity themes for 2022, which is basically the value plays, the small caps, and the emerging market, which is not so consensual. We like China as a whole, so this is less consensual because we think the emerging market can actually play well on a tightening cycle and eventually on a more dollar strength. But the dollar actually is already priced in pretty much of the tightening cycle. And when we take a look, of course, all this pain is not equally burdened, right? So we have technology in Europe dropping 11% year to date, and we have banks and energy going up around 10% year to date. So this is quite interesting and makes the alpha and active management far more interesting going forward than it was in 2021. And this monetary tightening, and where of course is undoubtedly going to happen, will probably induce some sort of reverse TINA and reverse fear of missing out. And we've seen this in all these growth speculative assets like the value growth. This is an ongoing battle. If we could choose someone to this burlesque showdown, we would of course choose Warren Buffett against Miss Cathy Woods. And of course, ARK is just dropping like a stone, and it's not still finding any common ground. So the speculative growth is pretty very, I'm not saying doomed, but it's pretty much going through a pretty big dive. And we think it will probably bound to continue. So and in regards to the other themes, we still think value, emerging markets, and cyclicals will probably do pretty well. So, but right now we're much more neutral on equities. Steen already acknowledged that the Fed put will no longer be the case, especially if you have inflation going high as this case. So the case for Fed tightening has to be compelled. So they won't be quite worried about a 10 or 15% drawdown in equities. But of course, if you think about 20 or 25% drawdown on the S&P, that might be different because, of course, if you have a 25% drawdown on the S&P, probably the credit spreads have already widened quite significantly, and the financial conditions already wouldn't be, of course, not too much loosened. So I don't think the Fed put is entirely out of the money. Probably the strike price is much lower than we previously thought, but still it's not out of this game. I would tend to agree with seeing around the 20 to 25% ballpark, which would be a drawdown where the Fed would be impelled to act, and actually the equity pressure would feed in to the credit conditions, and of course. So fixed income, we are negative on strategic and on tactical. Of course, more neutral positive on the emerging market and in inflation-linked themes, and on the equity side, neutral and more negative on the US market and more positive on Europe value plays, and of course the emerging markets and China, and of course a year where especially the alternative investments will be quite compelling to fulfill. And with this, I end, Diogo. I give it back to you.
Hello. Well, thank you, Steen. Thank you, João, for your insightful presentations. Following 1 month of this year going on, there's no doubt that the year is beginning with challenges. and the insights are more precious in this context than anymore. We are receiving several questions here, and I will try to aggregate and address the most important topics. Okay, one of the issues being raised is regarding, after all these quite aggressive changes of the Fed policy, and with 5 rate hikes already priced in, how do you see the terminal Fed rate playing out in the medium term? Because it's still quite low.
Oh, you want to have a go?
Yeah.
You go ahead.
No. You were talking about a corridor of around 200, 300 basis points. I would tend to agree that yes, at least 75 basis point adjustment on the upside. I don't know, something. Perhaps I would be a bit not so aggressive as Teen mentioned, but at least some 50 to 75 basis points higher than what market's pricing right now.
And I think the question is an excellent question, because I think that is where the policy interpretation is mistaken right now. This concept that you can fight inflation and then all of a sudden everything falls into place with a 200 basis point terminal rate is just not how history has played out, and it's certainly not how an economy, which for my money is extremely structural in its issue. We have just take Europe, we have a deficiency in energy, we have a deficiency in militaries, we have a deficiency in decision making. So, you know, these 3 deficiencies we have in Europe is not going to change. Whatever the ECB does or whatever the Fed does is not going to create more baseload electricity. It's not going to change the attitude of ESG investors. So the repricing that will happen ultimately is that we will move from a flattening of the curve to basically that the long end all of a sudden will start to accelerate and increase the terminal rate. That is what I foresee. I totally agree with the concept that another way to say this is that right now, if I was a fixed income trader, I would ignore any data point outside 2 years. You know, what has 5 years given you in terms of indication ever in the history? Zero. Literally statistically zero prediction value in terms of what goes on, because God knows what happens in 5 years, and God knows, again, even less what happens in 10 years. What we do know is the next 2 years, which is why the belly of the curve, as indicated, is the strong point. But right now, all the policy mistakes are being catapulted to the 0 to 2 year, where when the structural issue is recognized, when the inability to get inflation down, think about it, you know, in inflation terms, people are reporting CPI as if that is the economy's underlying inflation. The economy's proper underlying inflation is really PPI. And in case of PPI for Europe, PPI for US, and the PPI for China, it is not 4, it's not 5, it's not 7, it is all of them north of 10. So the concept that we go from 10% inflation to 2% inflation over the course of 12 months, it's never happened in my lifetime. And people continue to ignore that. So that will shift ultimately the terminal rate, in my opinion. So it's only a matter of time. But in terms of the Federal Reserve, remember, if you're a corporate, even if you're running a treasury asset and liability management, it's really everything is 0 to 2. That's where the big demand is from corporate. That's where the deep demand is for cash flow impacted A&L. So for me, it's just a matter of time for the market to grow up and realize that historically we're in a unique situation, and secondly that the inflation is structural. So yes, I believe the terminal rate will move from what is now 200 basis point, if you look at all the swaps and the forward rates, to 250 and 300 minimum. But then we come into a second, which could be the follow-up question: how much and how high a level can the US economy take in terms of the terminal rate? I think 200 basis points is also reverse engineering of how much can the US economy take. So, you know, the concept and what was excellently shown before in the presentation that, you know, stagflation comes to 250 basis point terminal rate. You're going to continue to have inflation because monetary policy right now is not doing anything in terms of tightening financial conditions enough. And at the same time, you'll have a massive slowdown in growth. So I think And then follows, of course, that the US have a deficit on savings relative to the current account deficit, which means that ultimately, right now, the interest rate will take the burden, and then the dollar will take the burden later. Because if you want to fund the deficit in current account terms, either interest rate has to be high enough or the currency weak enough to actually fund it. So I think there's huge ramification for this terminal rate in terms of its guidance. I agree that it's anchored right now, but I also believe that the single biggest mistake of the market right now is to anchor it at 2%.
Thank you. Sure. And still on the Fed policy, another question is regarding where do you see more risk? Is on they're doing too much or too little to constrain the inflationary pressures? Is too much tightening or not?
I think Steen was quite clear on that, right? He seemed quite clear. But really, what can US cope with it? I mean, 200, 250. Right now, you think it's doing too little. The risk is doing too little, and you have stagflation entrenching on the medium to long term. So that would be my case, as pointed before. So it's really unprecedented, uncharted territory that we're seeing.
But I think that is absolutely right, and that I think is exactly how Fed thinks. They feel that the more they can do in the short term, the less they can get away with in the long term. I think that is also a mistake, but certainly that is the thinking in the market, and that's why we have 5 hikes inside 18 months, 7 hikes inside 7 months, and nothing after that, basically. And then that is what Fed is thinking exactly.
Sure. Now moving a little bit to Europe. And the next question is regarding the energy crisis in Europe, and of course taking into consideration that Europe still imports around 80% of its gas consumption and around 35% from Russia. So how do you see these energy crisis impacting the inflationary pressures in Europe and impacting, of course, the European economy?
I think we have seen in the great presentation that the impact is, of course, on the disposable income, but it doesn't change the fact that what you have to remember, the policy response to all this will be to increase the amount of green investment we do, and those green information is going to make things worse. And into that you put the framework, which is that every single commodity in the world right now, including agriculture, has a carry yield, which means that the forward pricing of those markets indicates that there is a deficit between supply and demand. The beauty of the commodity market, which I much prefer to any other market in the world, is that it clears only on spot. If there's too much supply, the price goes down. If there's too much demand, it goes up. Unlike, guessing 5 years and everything else. What we do know about commodity is it's exactly only driven by supply and demand. And if you look to the underinvestment plus the new initiatives, we have a structural higher burden on energy than ever before. And then and let me say this very clearly, the idiotic policy of Germany and others to phase out atomic power and others has nothing to do with making nature less polluted. It's everything to do with trying to cater to voters, which is always at every turn of any political decision the wrong turn. You need to do the turn that helps nature and makes it a better place, which means we need more basic research on energy. And before we turn to this basic research and finding alternative to solar and wind, we are not going to be in a better place on energy. So I actually, in internal notes, call this the energy crisis of the 1990s repeat.
Jörg, do you have another? I think Steen was quite clear on this.
Yes, sure. We still have another question following the ECB meeting today and the speech today, which is regarding how do you see the debt markets in Europe, and how do you see the way ECB is managing inflationary pressures? Are they getting late, as Fed also got late? And do you see risks of spreads moving and wider spreads with these inflationary pressures in Europe during this year?
I mean, Steen, let me just address this first. I mean, they are late as the Fed, as they are all late, but in terms regarding the inflation, but as I tried to point out, I think the inflation pressure in Europe is much more supply driven than demand driven against the US. And you think about the massive fiscal transfers that you've had, right, going through the households. And for companies and the economic multipliers, so that translates very differently to the aggregate demand pressures in Europe and US. But still, I think it will slowly translate and spread over to higher demand. But I think it was actually quite interesting today, because today was the first time we've had like more than 50 basis points increase since the lows on the bonds, on the yield bonds. And just today we had some significant move on the peripheral spreads regarding some sort of, I wouldn't say a mismatch of Lagarde's speech, some discomfort around that. So I would say that it would be quite. I was expecting already when bonds would surpass zero, I would say there would be already some sort of slight pressure on peripheral spreads. I don't think they have a huge room to go, because it's part of the mandate of the ECB to keep some sort of price stability, and those funding spreads are within that same mandate. But I think the pressure is of course upward, and we see it very different playing out if you take a look at Portugal, Spain, or of course Italy. I don't know, Steve, if you want to address it.
Only, again, I totally agree with your analysis, but the difference and the mistake the ECB makes is, and it was very clear in the press conference today, she mentioned energy as something which is transitory, which is, you know, going to mean revert back. You know, how are energy, just practically, how, you know, what you know, I was almost using the F word, but what does ECB know about energy? You know, I sit on boards, I sit in energy companies. You know, they have zero clue what goes on. They don't understand the investment. They don't understand how a turbine needs to have steady electricity. So we are dealing with people who talk about something they have zero clue about, which is energy. So I think, you know, maybe the ECB in the future should get some energy experts on the board instead of people who just want to have a nice lunch.
Okay, sure. Still on this topic, we had another question which is regarding the CPI numbers. In case the CPI numbers show lower level from Q2, second quarter onwards, action.
Diogo, I didn't get your answer, your question. Sorry.
What do you think will be the market's reaction? Do you think the market will?
Sorry, Diogo, the sound of the question didn't come out very well. They have the same issues, team. Did you hear the question?
No, it's the same, but I think I get the question. So the question from the audience is that if interest, just correct me if I'm wrong, but if interest rate comes down from a base effect, how will the market react in terms of the high? Is that correct?
Yes.
So there are two. First of all, that is, I think we talked about. It goes to the question on terminal rate. It goes to the corridor on inflation. It's already priced to move lower. So what we as strategists and investors need to look for, what is the impulse that can change that? As I think you all know by now, I think energy is that component that will change it, because energy doesn't have a built-in supply side flexibility, which central banks is assuming. Or it is the wage inflation that goes crazy. So for me, you cannot really see a inflation environment that over or go dovish relative to what goes on, because what will happen is that independent on that slowdown in inflation, the structural decision by the Federal Reserve and ECB now and Bank of England is to hike interest rates to get ahead of it. So whether we move from 7% headline in the US to 4.5%, 4%, it is still significantly higher than the corridor they allow. And the problem they have, in my opinion, practically is the supply elasticity and the supply chain issues will remain. And as if I'm not mistaken, that is a lot what she talked about today. She didn't actually use the the supply side as an issue. She talked, like Fed did a couple of months ago, about inflation being entrenched and creating optionality. Optionality is only on the upside, unlike what she's seen before. So even inside the ECB, they now understand that when you have a chip deficiency in Germany for the car industry, it's at least 10 to 12 months out. So, you know, we will have a like-for-like base effect drawdown, but that will be made by opposing energy costs and opposing wage costs simply. And in the case of the US, you will also have the rental, the housing market, which is survey-based, coming up by what is equating to 6-7% increases in prices as well. So for me, it's a balance where the risk is really in the upside, not on the downside. But I agree with the question being asked that, you know, the consensus is we will see a significant drop, and I see a lot of people on Twitter already, you know, inflation is down at 2% by the end of the year. I wish them all very good luck with that idea.
Okay. We also have a few questions on the equity markets. One of them is, how do you see this current rotation from growth to value continuing during the year? And the other one is regarding which regions and sectors do you see the best risk return, considering these current tightening conditions going on?
Okay, I tried to address that in my presentation, and I mean, as I've told you, we were having this call of rotation from growth to value already since, of course, from the vaccines came out in November 2020, and so it took us more than 12 months for finally something like this starting to happen, and the tightening cycle, of course, linked to the tightening cycle. So it's not really a surprise. Of course, the movement in the last 6 to 8 weeks was quite steep, but I think it will probably, you know, as you have worsening economic data or stickier inflation, or if the Fed is not able to deliver those 5 hikes, you might have some relief rallies on the technology side. But I think that growth side is mostly those rallies are mostly used to sell on the upside and not the reverse. I think the value against growth is the structural play, at least for the next 18 months or so. And in terms of regions, of course, US, because of course it relies very much because of this of technology and this concentration risk for these big tech names. Of course, in this, if this materializes, which actually is doing already right now, of course, the US will tend to underperform world equities, and especially emerging markets, where I think is the biggest value in terms of fundamentals, in terms of flows, in terms of and they've done this preemptive tightening in terms of the commodities inflation cycle, as team has shown. So I would say the emerging market and the value play would still be my plays during 2022.
Thank you, João. We are achieving our limit of time. So thank you, João and Steen, for your insights, for this fruitful discussion. We do hope it was interesting for all of you, and it will help you guide your decisions and in your investments during this year. And so thank you again, Arturo, for the introduction, João and Steen for your presentations, and Saxo Bank for cooperating with us. And see you next time. Thank you very much.
Thank you, Joe. Thank you, Steve. Thank you, Arturo.
Bye-bye.
Bye.